All right, this is Ubay on behalf of V Electronics, and in this video, we'll be talking about how investment expenditure impacts aggregate demand or real GDP. All right, now when it comes to your investment expenditure, this has to do with capital investments and it has to do with businesses in general. Okay, so when businesses make investments, okay, they make investments in four categories. Okay, so number one is non-residential structures. Okay, so non-residential structures such as your commercial structures. Okay, so you have buildings, okay, distribution centers, for example, buildings for factories, okay, so on and so forth. So non-residential structures. Okay, the second component when it comes to investment by businesses, it has to do with durable equipment. So you have durable equipment. All right, now when it comes to your durable equipment, equipment has to do with things like vehicles or cars. Okay. Obviously, as you use your car, it depreciates over a period of time, as a result of which it's called durable. All right. Now, software has to do with software on your computer, for example, so on and so forth. All right. Now, the third component when it comes to investment expenditure, okay, has to do with inventory. Okay. So you have inventory. The company stocks inventory. So obviously, when company makes an investment in inventory, whether this is tools, machines, equipment, other kinds of inventory, okay, this has to do with your investment expenditure. Okay, and last but not least, okay, this would be residential structures. So residential structures. So if you have a construction firm, for example, that makes an investment in residential structures to sell them in the market to homeowners, to home buyers, so on and so forth. So you have residential structures. All right. Now, when it comes to your investment expenditure, okay, these are the four categories that you have to look out for. And there are two factors that impact each and every one of these categories. Okay. Number one has to do with expectation of future profit. Okay. So we have factors over here, and this has to do with economic factors, something relevant to economy, just like your cyclical unemployment, which is relevant to the economy. Yeah, these factors have to do with the economy, and these are components of investment expenditure. All right, so this is expectation of future profit. Okay, what that basically means is that when a company or a business predicts that they will make money in the future, let's say because of the prices that may go down, okay, prices such as prices for crude oil or gasoline, okay, they will obviously invest more in the future than in the current market. Okay, so they will invest in the future market rather than the current market. So expectation, okay, of future profit. Now, on top of that, if they do figure out that their investments today will be worth much more 5 years or 10 years from now, they may go ahead and invest today. All right. So say, for example, if this is real estate, if the real estate will be worth 20%, 30%, or 50% more in the future today, then obviously today would be a good time to invest. So as a result of which, okay, if the profitability goes up, If the profitability goes up in the future, okay, the businesses will go ahead and invest, which means the investment expenditure will go up. If the profitability in the future goes down, let's say the investment or the return on investment is not too high, it could be in negative, it could be a negative return on investment, okay, as a result of which the companies or the businesses, okay, will stay away from that investment. Okay, so here the investment expenditure goes down. All right, so this has to do with expectation of future profit, and this works the same way as your aggregate demand when it comes to personal consumption, okay, such as personal consumption of crude oil or gasoline. Okay, if okay, there is expectation that the future profit will go up, okay, because the gasoline prices will go down, then obviously um, businesses will go ahead and invest in the future. And likewise, if they feel that their investments, okay, the investments they make today, okay, will yield a higher return in the future, then they will go ahead and invest today. Okay. So apart from that, you have your interest rates. So your interest rates over here. So when it comes to your interest rates, we know that interest rates impact investment in general. So as the interest rates go up, the investments, okay, may go up as well. Okay, that is interest rates. If they go up, okay, your investments will go up. Expenditure will go down. All right, so if you do make investments, you will not use that investment for now because the interest rates are high. Okay, if you do make a deposit, okay, in your savings account, you will not use that savings account for the time being because you know that you're better off saving that money in your savings account because of high interest rates rather than spending it somewhere. All right. So your interest rates go up, okay, your expenditure goes down, but investments in general they go up. Okay, as interest rates go down, your investments go down, okay, but your expenditure go up. So as the interest rates go down, we know that you will be spending more because obviously you have to pay in monthly fees, okay, when it comes to your interest expense, as a result of which your expenditure goes up, just like your personal consumption, where personal consumption goes up as interest rates go down. All right, so that would be it when it comes to investment expenditure components, as well as factors that impact investment. Okay, and apart from that, this is Obey on behalf of B Electronics. Have yourself a great day.